and thank you for joining us today. My name is Bernard Delbecq. I am a Senior Director at EFAMA, and I have the pleasure of moderating today's discussion. 3 years ago, a coalition of associations launched European Retirement Week with two clear objectives: to raise awareness about the pension challenges facing Europe, and to provide a platform for discussing a solution to help Europeans secure adequate pension income in retirement. And EFAMA is proud to have played a key role in launching this initiative because we strongly believe that encouraging people to save more has become a key priority in Europe. Today's event is centered on three key tools that have demonstrated their effectiveness in promoting greater retirement savings: auto-enrolment with an opt-out clause, pensions tracking system, and investor education. If you have been following recent ongoing debate on pensions gap across Europe in recent weeks and months, you have likely heard policymakers and stakeholders emphasize these tools as part of the solution. However, despite their potential, public knowledge about these tools remain limited, and it's quite clear that implementing these solutions require significant planning, coordination, decision-making to ensure their effectiveness. It is this reality that convinced us that it was making sense to organize a debate around these tools, and actually to choose as a title to today's webinar, Turning Great Ideas into Concrete Actions. To explore this topic, I am delighted to introduce three outstanding colleagues who have kindly agreed to share their insights on the potentials of these tools. Steven Janssen is the CEO of the organization that is in charge of running the Belgian pension tracking system. So we're going to learn about this system. Before joining this organization, Steven accumulated a rich experience in pension policy, including by being Chief of Staff of the Belgian Minister of Pension for several years. Obviously, Steven there will share with us today insight into the factors contributing to the success of the Belgian tracking system. Jerry Moriarty is the CEO of the Irish Association of Pension Funds. He's also the chairperson of Pensions Europe, a partner in the European Retirement Week here in Brussels. And Jerry has also been a member of IOPA Occupational Pension Stakeholder Group for many years. And Jerry will give us insight about the design and implementation of auto-enrolment in Ireland. And last but not least, Anne Lester will share her views as a writer and speaker on retirement savings issues. Anne wrote a best-selling book entitled Your Best Financial Life. And for anyone interested, reference to Anne's book can be found on our website, annelester.com. And before working on her book, Anne was head of retirement solutions for JP Morgan Asset Management. We have agreed to structure the webinar as follows. Steven will start, and this will be followed by Jerry. Steven and Jerry will make a brief presentation, which will set the stage for a deeper conversation to enhance our understanding of pensions tracking system and auto-enrolment. And following this discussion, I will invite Anne to share perspective on the US pension system, some element of the system, and of course to discuss the potential investor education initiative in motivating the younger generation to save for retirement, at least just to start saving early for retirement. The webinar is recorded, so you have a chance just to listen to it again, or to share later on the link to some of your friends and colleagues, and is scheduled to conclude at 5:15. So let's start with pension tracking system. Steven, you have prepared a few slides about Belgium system. My colleague Miriam will start sharing them, and I'll give you the floor.
Well, thank you, Bernard. Well, you asked me to make 2 or 3 slides. It ended up being 9, so I really have to rush through all the slides. I hope it remains somehow understandable for the people who are listening. One thing I think we should know, or remember at least, because we all know this, there is not the pension does not exist, the pension system, the pension problem, the pension solution. No, you always have country-specific ways of how systems and problems present themselves, and so also solutions are country-specific. So I'm not going to present you the pension tracking system. This is a pension tracking system as it suits Belgium. And that's so actually to understand how a pension system works and why it does deliver certain functionalities and not other functionalities, why it stresses more some or has a certain focus and not another focus, you actually have to know the pension system behind it. Don't worry, I'm not going to explain the Belgian system, but I really will need to make some references to certain aspects or characteristics of the Belgian system. Otherwise, you probably would think that we delivered a very bad tool. And perhaps we did, but that's at least not my view on the thing. So let's start. It's a pension dashboard. We don't call it a pension tracking system because losing your pensions is just not an issue in Belgium. So we don't have to track them. Of course we track them. That's the implicit functionality of the tool, but we call it rather a pension dashboard, not a portal that gives you access to a lot of services. It's a dashboard that gives you an overview of key parameters, or at least what we consider to be key parameters on Belgian pensions. Well, it's built incrementally. It took us a lot of years to build it, and I don't see that to be a problem. I think increments can be okay as long as your increment is well defined and it's clear in the communication what you do and what you don't do. So a first lesson about Belgian pensions is that we have in the first pillar still 3 regimes. We have pensions for employees, for self-employed, and for civil servants, and never the 3 shall meet, although there are a lot of similarities between them and they tend to merge, but still we have these 3 different regimes, and that allowed us also, there were also practical and technical reasons why we did so, but we started with the employees in 2010, and that's a clear message. All employees could use my pension, but only employees could use it. Is that a problem? Of course, you have unhappy self-employed and unhappy civil servants, but at least this was a first increment. It was not holistic, but we started. And you see, this is the first 7 years, I think, or 8 years. I studied law, so I'm not very good in mathematics. Well, we added, first of all, within the first pillar, the other regimes. Then we added the second pillar. Then we first, only in 2017, after adding these building blocks, we added a global estimation for all first pillar pensions combined. So that was not even in 2015 that was available. It was only an increment that came later. We did some gimmick in 2020, and then we started building additional functionalities. The first pillar, or the My Pension portal, is actually an extension of the administration. It's interactive. It has transactional functionalities. You can claim your first pillar pension via My Pension. You can do simulations for the first pillar on effects that career choices have on your first pillar pension. As I said, the claiming of pensions over all regimes is integrated in My Pension, and we will start doing that also for the second pillar in 2025. In Belgium, the second pillar take-up is mandatory if you take your first pillar pension, but in certain conditions you can do an early take-up of your second pillar pension, and this can be done via mypension.be. We will contact all pension providers behind your second pillar and inform them that you would like to go over to a liquidation of the second pillar pension. We will do a complete rework on the second pillar in 2026. That's 16 years after we started. This is the first version 2 of the second pillar. It will be a massive change, but I will come back to that. And we still don't have, it's an X, 2020X, could be 2030X. we will do the global amount. This is the second thing you have to know about the Belgian pension system. Pay as you go in the first pillar, almost completely lump sum in the second pillar. In addition, median and average amounts in the second pillar are so low, so let's say modest, not to get everyone in a depression. It's modest amounts, so converting that into annuities just for communication's sake doesn't make much sense, but we're going probably into that direction. Now, what are we showing? First pillar, as I said, we have a complete 100% coverage in two meanings. We cover all schemes, but we cover also all people. Unless you're in the black market, black labor market, you're always covered by the Belgian social security system within your regime. You will always have a pension. And also all data are available at just two social security institutions, so we don't have a big problem of data collecting. We focus on what is important for the first pillar. Actually, your two amounts. What can I get net at the earliest possible date? What do I get at the statutory retirement age? Those two amounts are shown. Those two dates are calculated because the first one is dependent on your career history. We show the career because that's even tracking a career is more important than tracking the pension. If you have a career, the pension will follow. So we need to make sure that we have your complete career and all your wages, because that will determine what pension will follow from that career. In the first pillar, you can simulate. You don't simulate the pension, you simulate the input. If I work more or less, if I earn more or less, if I change my professional regime, then you can simulate the impact on your pension. So very basically three important questions. Do I have a pension? How much will it be? And when can I get it? And these answers are given for the first pillar with some additional tools like the simulation tool. It's basic. What I'm not showing is all the interaction tools with the administration. You can do follow-up of payments, follow-up of administration. You can communicate information to the administration. You can follow up your tickets that you opened with the administration. So it's an interactive tool, but in terms of pension information, this is basically it. And that covers, as far as we know, the needs of most people. Second pillar, a different story. The second pillar, we don't have the basic data to calculate your pension amounts. We have the resulting pension amounts. The basic data is with the pension providers. There are about 184 pension providers. We cover them all. We cover all the schemes, but we don't cover, of course, the schemes don't cover all the people. That's different with the first pillar, which is universal. The second pillar covers around 77% of people who are within scope. I mean, they are actually on the labor market. If you're not even on the labor market, no access to the second pillar, of course, but only 59% actually has an active account. So we have a lot of almost one third only has dormant accounts. What do you see on the landing page? You have the total vested reserves. That's the only common denominator we have in the second pillar. These are the vested reserves. You can go into the past of your previous benefit statements. This is basically a digital benefit statement. You can download all your documentation, your pension scheme documents. You can split this up in what did I build up as an employee, what did I build up as a self-employed, and that's the third thing you should know. Civil servants do not have access to the second pillar. Their pension is considered to be so generous that there is no room for a second pillar under Belgian law. So we focus here just on two regimes. And you can also see what your beneficiaries could get if you would die before reaching the pensionable age. This is a general screen. Then you go to a drill down. You choose the professional regime you have, employee, self-employed. You get a list of all the pension entitlements you have as an employee. In this case, the person on the left hand only has one scheme. We see who the provider is, who the organizer and the sponsor is, what kind of scheme it is, whether he's still active or dormant in that scheme, and then he can drill down, that's the right-hand image, to a detailed benefit statement on his pensions. And that's at that level you see vested reserves, vested benefits, and expected benefits that are communicated. We even have account parts. That's some idiosyncratic thing in Belgian legislation, that some parts of your account need to be managed separately depending on the kind of characteristics they have. As I said, you can do a download. I don't think the animations are working. On the left hand, you see the current download, which is a standardized document for all kind of pension entitlements. It's standardized, downloadable, and pension institutions who want can opt in and replace their own benefit statement by our benefit statement. We will even send them to all digital clients, as we call them. But I already announced a big change in 2026. First of all, getting your benefit statements via My Pension becomes mandatory for the whole Belgian market. You should make your benefit statement via mypension.be on a standardized, uniform way, and the content changes. We actually did the IORP 2 requirements. We implemented them for the whole Belgian market, so also for insurers. And this will give you, this is basically also what you will get online. First of all, where am I? What's the duration of my affiliation in the pension scheme? What's my reserve at this moment? And to which amount, what are my expected reserves, expected benefits if I continue to the pensionable age of 67 in Belgium. At the bottom of the first page, you see what we call the bank account approach. We know your last penultimate vested reserves. What's the amount of money that came in terms of premiums and contributions paid? How much tax and costs went out? What was the return on the capital you had? And then you have the new amount. On the right-hand side, you see the IORP 2 additional information on worst case, best case, and more realistic case, kind of, let's say, margin of evolution you could get in your future amounts. There are some additional information, but I think this will be the major change in 2026. In terms of people who are actually using it, because it's nice to have websites and to change them, to change the colors and the content, but if people don't use it, then it's just nice for the IT service. I don't know why 2014 is not on the slide. I just saw it half an hour ago, so it's nothing I can do now. But we think we will end this year with 3.6 million users, unique users this year, which is 6 times the amount we had 10 years ago. I have some information on who's using it. Not surprisingly, 50% of the users are above 45, the age of 45. But that also means that a lot of them are below that age, but it increases with the age. And we also have people who are already in the payout phase and still continue using the My Pension tool. Well, that's in a very short run what I have to tell about mypension.be as it is at this moment.
Thank you for your presentation, Steven. You mentioned that most of the users are at least 45, and just one question: when you said that if you go to the system, you would know how much you're going to get as a pension at 65 or 67 in Belgium, right? But if you are 45, then is this amount based on your career until then, let's say 20 years or 15 years? Or is there any assumption about the rest of the career, the average salary that you may hope? So how is this calculated?
That's one of the problems we have with coming to a global amount first and second pillar together, because in the second pillar, of course, you have the money that's already there, vested reserves. That's actually your build-up past until now. Your expected benefits and expected or vested reserves are actually a projection based on what we know now, but under the assumption that you continue contributing and then you will get a future amount. In the first pillar, we don't do the first part, we only project. So you actually have to go into the simulation module and choose the scenario, I stop working completely. Then you will get the amount that you, in current value, the amount that you will get when you stop working completely. But for the first pillar, we project always based on your last known data from your career. This is the assumption we will use for the rest until you reach the pensionable age.
So okay, so I mean, it's a lot of information. So, it's just impressive. And I must say, as a Belgian, I use or I visited a few times the site, and I must say I haven't seen all these details. So I need just to go back. But that suggests, the following question to me. I mean, the level of financial literacy, understanding, is rather limited in many countries. There's a lot of information. You can simulate, as you said, different scenario. I mean, do you think that Belgium users can understand this information, or is this concept like vested reserves and entitlement? Is this a concern that you should address or that you are addressing?
Yeah, because we don't use the term vested reserves. Nobody would know what that actually would mean.
Exactly.
And we actually involved all social partners and did some user testing to check which term would actually give the right information to people. Make certain associations with certain terminology. That could be a good one, it could be a bad one. What is sure is that the actuarians and the legal department will never like the result, but our focus is on do we get the right result with the users? Not the question, is this legally correct or is this actuarially correct? So I think we talked about what's the money that's saved already on your account, that's already available. Of course, it's not saving, it's an insurance in a lot of cases, and it's collective capitalization in a lot of funds. So there's no actually my account and my claim and my money that's over there, but that created the best understanding with users up until now. Now, a lot is going to change in 2026. So we're now again in an exercise. It's already busy for 1 year. It will continue in 2025, redefining the vocabulary, redefining the terminology. Of course, we cannot diverge too much from what is known until now, because then we have to explain why it's not the same anymore. So we're a bit limited in how far we can go. But that brings me to the point is, financial literacy is important if your system depends on it, in people understanding what is happening. Of course, I'm not saying people should not know what is happening, but a 14 you should know about the Belgian pension system, and that this also puts things in perspective regarding the two topics that are going to come, auto-enrollment or financial literacy. It's important if your system depends on choices. In our first pillar, you don't make choices as an individual. You start working and you're in the system. The only thing you can decide is to work more or less. You cannot even, well, as far as you can decide it, you can also technically decide to earn more and get more pension, but that's the limit of decisions you can take. And in the second pillar, all decisions are taken by the organizer. It's the employer that chooses the kind of product, an insurance, a pension fund. It's not the individual that can choose between investment portfolios. So there's very little choice to make in the first and the second pillar in Belgium. So we're not that much focusing on helping people making decisions. The only thing they can do is, well, go to the third pillar. And unfortunately, we don't cover the third pillar yet, I should say, because it pops up in coalition agreements once in a while. It doesn't get very concrete on the website up until now. But that would be, I wouldn't say a game changer, but that would change a bit the role we have to play.
Okay, Steven, I think we could discuss that for a long time. Fortunately, I said that this event would close at 5:15. I should have said 6:15. But maybe one last question, and then we see whether we have more time. But I'd like to give the floor then. Jerry, would you have a recommendation to some member states that have not yet implemented a pension tracking system? You said it's a long journey. It's just quite complex. I mean, is there a key message just to give to those policymakers that possibly would listen to this event?
Well, is a fraction advice is do start. That helps demystifying the complexity of things. Start incrementally. Define things that are doable at a certain moment, and then learn and do the next things. And don't try to be holistic. Try to focus on basic questions, get answers for that first. Those 5% of people that actually need a lot of more specialized advice, they are served by the market. If you're building as a government, at least or publicly funded a tracking system, make sure that you cover 90% of the needs on the market, and then learn also about what these needs are and build further on that. I think that would be my advice. Start and learn.
Okay. Thank you very much, Steven. Let's shift to another key topic, auto-enrolment. I would say it's hard to have a serious discussion about pensions reform in Europe without mentioning auto-enrolment. It's often regarded as I would call it a cornerstone solution for increasing pension savings. Enrico Letta in his report is talking about enrollment even in the context of the PEP. So this is just a new term in jargon that is being used in Brussels and among people discussing pension. Still, auto-enrolment is not widely implemented across Europe. So to understand why, I'm delighted to hand the floor to Jerry, who will share some key insight into how auto-enrolment will be implemented in Ireland. So we get concrete cases. Jerry, you have the floor.
Great, thank you. Yeah, before I go into the design, maybe I should just talk a little bit about why we're introducing auto-enrolment in Ireland. So Ireland has a multi-pillar pension system like most countries. Our first pillar pensions are a little bit unusual in that it's a flat rate pension that's provided at retirement. So anybody who has sufficient social insurance contributions over their working lifetime gets the same pension as everybody else with the same amount of contributions. There's no earnings related element to our first pillar pensions. And our first pillar pension is really designed to keep people out of poverty rather than give them a good replacement rate in retirement. So in order to have a good replacement rate and for most people to live the kind of life they would like to have in retirement, you need to have supplementary savings. And for employers, it's not compulsory to provide a pension for their employees. So we've ended up with about half the workforce or less than half the workforce who have pensions. And they tend to be in semi-state organizations, financial services, pharma, tech, well-paid jobs or jobs with good union representation. And then in industries like retail, hospitality, agriculture, where you've much more transient workers, lower paid workers, they tend not to have pensions. So for a long time, we've had a very young population. We've been able to look at this as an issue for the future, but our population starts to age really quickly. So rather than build up an issue, auto-enrolment has been deemed to be the best solution to address this, the coverage issue. In the absence of it, I don't think politically there could be an agreement to have mandatory pensions there. That's why you go for auto-enrolment, so people have an opt-out element. In terms of who's going to be covered, so any employee who's not currently in an occupational pension scheme, employees over the age of 23 and under age 60. 23 is chosen because the vast majority of people go to third level education in Ireland. So that's generally the age at which people enter the workforce. Been a lot of discussion about that, whether you should have people in just when they enter the workforce, even if it's younger than that. But it's chosen as 23. Under age 60, because our retirement age, state pension age is age 66. So it's sort of deemed not really much point going in beyond that because you don't have much time to accumulate. Again, I would argue against that. Anybody earning over about earning over 20,000 euro a year. For a full-time employee in Ireland, average earnings are about 50,000. So again, if you're choosing a sort of earnings limit, it's based on, you have to consider people who just can't afford to save for retirement because they're struggling to live on a day-to-day basis. Whether 20,000 is the right number or not is debatable, but it's logical that there is an earnings limit there. Anybody who's not automatically going to be enrolled can choose to join themselves. So people earning under 20,000, people under age 23, people over 60, they can actually choose to join. We're sort of restricted on the opt-out. So in the UK's auto-enrolment system, you can opt out immediately. We're going to restrict opt-out, so you can only opt out after 6 months in the system, and then you can only opt out in months 7 and 8. So you've quite a limited window for opting out. The rationale behind that is that for a start, after 6 months, people will have got used to the contributions being deducted from their salaries. And also, hopefully, they'll have seen the benefit of those savings. So, you know, they'll have seen the deductions from their own salaries, but they'll be able to see how much the employer contributions and the state contributions will add to that. So I think there's a hope that people actually see this is actually a good benefit and they'll continue in. Even if you opt out, you're going to be re-enrolled every 2 years anyway. So it's almost a case of, you know, we'll keep coming after you and you'll eventually just give up and stay in the system. It's expected, officially the number says 750,000 people. We've had a huge increase in the workforce over the last couple of years. So I think that number is probably out of date. I think that was calculated quite a number of years ago. In the last year alone, we've had an extra 120,000 people join the workforce. We're expecting about the same to be added to the workforce next year. Currently have a workforce of about 2.7 million. So I think that number is probably closer to 1 million rather than 750,000. In terms of the contributions, and this is quite important as well, is because we are aiming to have a system that not only provides coverage, but also provides adequate benefits. So ultimately is 10 years after the start, employee contributions will be 6%, employer contributions will be 6%, and the state will have a direct contribution of 2%. So that means there'll be 14% of salary being saved. That's going to be phased in because obviously starting at those levels will be quite a shock for employers and employees. It's going to start at 1.5% for employees and employers, half a percent for the state. And then after every 3 years, so in year 4, that'll go to 3, 3 and 1, and then it'll go up by 1.5, 1.5, 1.5 again in year 7. And then by year 10, you've got your 6, 6 and 2. And also what's quite important, it's going to be on total earnings up to a maximum of 80,000 a year. So a lot of systems have sort of a band of earnings as they have in the UK. A lot of occupational schemes would only operate contributions on basic salary and wouldn't include things like overtime or bonuses or shift work, for example. But this will be on your total earnings. So it will be, you know, a relatively significant amount when you look at it that way. And then just in terms of the operation of the system, so it's going to be overseen by an authority called NERSA, which is the National Auto-Enrolment Retirement Savings Authority. Effectively, there will just be one scheme that does this. They will have responsibility for enrolling people. So again, unlike other countries where it comes down to the employer, this is going to be done centrally, and it will be the employee who will be enrolled rather than, for example, the employer having to find a provider. And one of the benefits of that approach is that you prevent the situation of having lots of members having lots of small accounts because they move providers every time they move jobs. So, you know, unless you join a company with another occupational scheme, if you're auto-enrolled, you stay with the same pension for your working career. The administration contract has been awarded over the last couple of months. That's gone to Tata Consultancy Services, who also administer Nest in the UK. The tender for the investment managers is due to issue in the next few weeks. The idea is that there will be 4 investment managers. They will each provide a lifestyle default option, and then they will have options that members can choose, so a low, medium and higher risk options. It's expected the vast majority of people either won't make a choice or will choose the default. So that's where, you know, if you look at other systems, over 90% of members will end up. Start date is currently scheduled for the end of September 2025. That's moved quite a bit in recent times. Until very recently, it was due to start early in 2025. I think 30th September is certainly more realistic. Although I wouldn't be surprised if that moves out to the beginning of 2026, just considering what still needs to be done. Excuse me. It's going to be called My Future Fund, which I think is quite a good choice in that it links it to the individual. I do think one of the problems in getting people to engage with pensions is quite often they feel like it's nothing to do with them. It's something to do with their employer. They don't really understand it. They don't really follow it. I'm sure some of the people here will have experience of the Australian system where people do really see it as their fund. You know, they talk about My Super and they have a very good concept of what it's worth. They seem like they feel a bit of ownership of it. So I think that's really important in sort of getting success. So My Future Fund certainly is a good start in that direction. Retirement will only be available at state pension age, which is currently age 66. That has been planned to go to 68, but politically that's proving very difficult. So I think we might be stuck with 66 for some time. It will have the same payout options as existing DC schemes, which at the moment is you can use your fund at retirement either to take an element as tax-free cash and purchase annuity with the balance, or you can transfer it to an individual retail product, an approved retirement fund, which you then continue to invest throughout retirement and use to draw down as you need. I do think, though, by the time auto-enrolment is up and running, we expect to have legislation that will allow for drawdown within an existing scheme, and I think the auto-enrolment scheme will probably do something similar where options will be offered to members so they don't have to switch to a retail product, because one of the reasons you're being auto-enrolled is because you're not going to make those types of decisions yourself, and if you're used to having decisions made for you throughout the accumulation stage, you're not really going to appreciate having to make difficult decisions when it comes to decumulation. So I think that would be good. It will be digitally led, so the idea is that most of it will be done digitally. People will have an app; they'll be able to view their account balances there. They will obviously get the type of benefit statements that Stephen demonstrated. That happens for all existing schemes in Ireland at the moment, and like I said, it's not clear that at the end of September next year, but I am pretty confident that certainly by the end of or the beginning of 2026, we should be up and running and finally have auto-enrolment in place. So, got details there if anybody wants to ask any questions, but obviously quite happy to have a discussion around it.
Yeah, thanks a lot, Jerry. And indeed, as I said, the event is recorded. You have the email address of Jerry, so I'm sure you can reach out to him. My first impression is the same as after the presentation of Steven, is that yeah, it is a great idea, right? I mean, that's but then just to implement it, when we see, and this was kind of a short presentation, but just so many decisions needs to be taken, just to make sure that it is done in the best way possible with the right level of investor protection and compliance and and all the like. Jerry, is this a reason why it took so many years? Because I think that auto-enrolment, been discussed in Ireland for very many years, right? So why is it? Because it's so difficult to reach an agreement on all these aspects that it's difficult to get auto-enrolment started. You even mentioned 26, right, instead of last year. What's your view on that?
Yeah, I think there are a number of factors. I think it's difficult to get political agreement around this. I think there is a widespread recognition that yes, this is the right thing to do. But I think politically, you don't really get thanked for imposing sort of pain now for something that's going to provide gain way down the line. So that's one issue, and that's just the way politics works. Everything's based in the short term. Your landscape is the next election, which in our case is 5 years. Actually, it's in 2 days, but generally that's as far as people look forward. So I think you need to be really far looking into the future to realize, yes, let's take the pain now. This is the right thing to do. I think there's an element as well of sometimes just looking for the right time to do it. And I think one thing I've learned is there's never really a right time. So, this is first seriously considered about 20 years ago. At the time, Ireland had a real booming economy, and there was a concern that actually if we do something like this, it might impact on that. Then we went into a recession and financial crisis where it's definitely not the right time to do it. Now we've got a really booming economy again, but there are a lot of concerns about the impact on business and the cost of living crisis. I think sometimes with these things, you just need to start. And, perfection can be the enemy of the good, because, you can be tweaking and trying to get the best thing possible. Sometimes, Stephen talked about building blocks, just get it up and running and then sort of add to it as time goes on. So I think those are probably the main issues. And then I think the current delays are more down to actually probably not really understand the complexity of building a system, because we are building a brand new system that's got to cater for 1 million people. We're working on a different type of government contribution where it's a direct contribution rather than tax relief. There's a huge element in engaging with payroll providers, changing payroll software. And auto-enrolment is really going to impact a significant amount of very small businesses. So, you know, there's a lot that needs to be done. And I think it's only as you get into the final stages of planning that there's been a realization around that.
Okay, thank you. Thank you. You know, this political difficulty that you mentioned, I would have thought that, you know, because imposing savings, you know, out of your salary may be difficult. The opt-out clause, is it not part of the solution to say, I mean, you guys, you don't necessarily have to, right? And then, you know, it's your choice. You should, but apparently, you know, this is still nevertheless not totally, let's say, the right solution to counter this political hesitation.
Yeah, and I think that's why you ultimately end up with auto-enrolment rather than mandatory pensions, because at least you've got that in terms of, okay, well, then that is the answer to that you can opt out. Obviously, the design makes the opt-out a bit difficult, so you have to stay in for 6 months. And again, the idea is you rely a lot on inertia. You know, people have had the contributions go out for 6 months, so you know they've got used to that. They will stay in, and hopefully a bit of they'll actually see, you know, how their account has been growing in that time and see the benefit of it. But it does probably rely as much on inertia as it does on that sort of awareness as well.
Yeah. Just a small, I mean, specific question on your slide where you mentioned that there would probably be, or there will be 4 investment managers, most likely have been selected, right, to be able to offer some solution and default. Does it mean that I don't know, the firm or the employee will have, you know, the ability to choose which one to choose, or?
No, so the original plan had been that it would almost, the investment management would operate on a carousel system. So, you know, I get auto-enrolled on a Monday and I go to manager A, you get auto-enrolled on Tuesday, you go to a manager B. Somewhere along the way it was decided to change that. I think particularly around concerns that, you know, manager A has a spectacular year of good returns, manager B doesn't, and you're looking at me wondering why my account is bigger than yours, and we sit beside each other, for example. So the plan now is actually that the contributions are just going to be split equally between the managers. And having 4 was how the carousel system is going to work. I'm not sure if you're just splitting contributions between managers, you need 4. So I think the idea at this stage is to tender for the investment management service, and it may not be 4, it might be fewer than that. But the contributions will then be equally split among the managers, so the returns are equally split then among the members as well.
Thank you. Anne or Steven, would you have a question or comments? And I know that kind of in the US, there is some kind of, I don't know how to call it, degree of auto-enrollment, you know, that may just be available. I mean, any questions or comments on this tool?
I guess I am a huge fan of auto-enrollment, and I think, you know, if you look at what the Australians have done, which is essentially a mandatory system, although I understand it is possible to kind of get out if you really, really want to. And self-employed people, I think, have a way out, but it's very effective. And I think what I particularly will be curious to see how it works is this re-enrollment, because certainly in the US, companies who auto-enroll and then keep re-enrolling really do see it stick after a while. People kind of give up and just say, all right, fine, I know I should do this, I will, or whatever was happening in their life at that moment that made them stop. You know, maybe they've moved beyond that financial difficulty and now can enroll. So I'm very curious to see how that goes. And I think it's great to have conversations like this, because all of us can learn so much when we look at all these other systems. And speaking as an American who, you know, we've just celebrated the 50th anniversary of ERISA, which is the law that sort of set the 401k plan in motion. We've had a long time to build up assets, but we've also made a lot of mistakes, I think, in the way we've structured the system, or maybe made unintended, there are a lot of unintended consequences to choices we've made. And so it's terrific seeing, you know, countries, whether it's Ireland or the UK or what you're doing in Holland and Belgium, to be innovative and to see ways that we can all learn from that improvement. So I think it's terrific.
Thank you. And Steven, do you have a comment? Would you wish, for instance, or would you also your experience in pensions policy in Belgium? As far as I know, I mean, there is no auto-enrolment, at least mandatory organized, at the level of the federal government in Belgium. Would you advise that, to the next Belgian government just to consider these to complement the pension tracking system? You're on mute. Huh? You're on mute. Yeah.
It does help if the mic works. Well, since we already have the universal coverage in the first pillar and already getting to 77% in the second pillar, well, the argument goes double. So why not find a solution for the remaining 23%? That could be some auto-enrollment solution. On the other hand, some argue that, well, with the current system, we already got to 77%. Why change it and why add a layer of complexity to it? But on the other hand, it will be for the second time that we have the ambition, or the new government, a government will pronounce the ambition to get to 3%. We did the calculation. Of course, it's one thing to get to 3% if you already have a second pillar, which is modest, and not just modest in results, is also modest because we have these low contribution percentages. But the big gap is, of course, getting 3% to people who have zero now, who are not in the game. So if, well, the game is not the right word, but we're not in the second pillar. But I think if we would stick to the 3% objective, and this will probably, if it works out, will become the 4, the 5, and the 6% objective as a minimum standard in the second pillar in the decades to come, because I don't believe it will happen in years. Then this could be a solution, of course, because there's a reason why 23% are not in a second pillar. And if you continue counting on employer initiative, then it could become difficult. We have an experience. There was this individual private pension product we made for employees. I think of the whole Belgian market, that there was no auto-enrollment. There was just a choice. You can add this, and that it's most of all beneficial for people who don't already have a second pillar, because there are these cumulation rules. I think around 1,000 people, they're in our database somewhere, because we have to look at it with a magnifying glass. But I think 1,000 people on the market of almost 4.67 million made that decision. So that also shows that leaving it up just to free choice will not solve your 3% gap and those 23% coverage gap. So then we probably have to start thinking about systems like auto-enrollment. But that's a change of conditions, of course. The change of conditions depends on policy choices where we want to end up.
Because as I understand, and I don't know what's the equivalent percentage, Jerry, like in Ireland, but the auto-enrollment will be reserved to those who are not enrolled, if I understand well, yet in a second pillar plan, right? So maybe the percentage is higher of those not member of an occupation plan in Ireland.
Yeah, it is about 50% of workforce who are not. But one of the things about auto-enrollment systems nobody's really solved yet is that it only deals with employees, because they're getting paid a regular salary. It's through a payroll system generally. Whereas for self-employed people, you don't have an employer as such. The employer is the employee effectively. That's been put on the things to look at after introduction as to how you might do that, whether there's an opt-in process or something. But I'm not aware of any country that's really cracked that sort of self-employed. And you're seeing more of that as well with gig employment, gig economy. So I think that's something that countries are going to have to look at closely as well.
Okay, thanks a lot, Jerry. While listening, I mean, to you until now, I said at the beginning, we talk a lot about auto-enrollment, pension tracking system. We still don't know very well, how these systems are working. And I wanted just to go, to dive and to know everything about those systems. Today, I'm afraid that we are still, at the surface, right? But the presentation, and thank you very much for the slides also, still, I think I would hope for the participant in this event, give you, a good, better understanding on, especially if you want to implement such a system. But now, moving to the third topic, and actually it is going to be, I would say, divided in two part, because Anne is American. So I would like first just to, maybe to clarify a few things about the US pension system, because, the talk of the day in Europe, in the letter report, and, in the mission statement letter of Mrs. von der Leyen to our commissioner designated, is that there is a pensions gap in Europe. And I wonder whether the United States actually also face a pensions gap that could threaten the quality of life of many Americans in the coming years or decade. Is this a political question as it has become now in Europe, Anne?
It's a big source of stress for many Americans. In fact, 3/4 of Americans, when they're surveyed, say that worrying about their saving for retirement, their retirement savings, is their #1 source of stress in their lives. Now, that survey was done maybe 2 years ago, so maybe they'd say inflation now, but it is certainly a huge problem. I'd say you asked, what about the pension system in the US? My short answer is it isn't one. We don't have a pension system. We have a series of sections in our tax code that have created privileged tax advantage savings and investment earnings schemes or systems that have been used to, incentivize employers and employees to try to save and invest for retirement. Pensions were started during World War II as a way of improving employee benefits because there were wage controls put in place. That's when our healthcare system started too, by employers. So in the US, pensions and healthcare have been employer-based. And when ERISA was passed in the early 70s, in 74, there was one provision in the tax code that sort of was the provision 401k that launched this industry. And I think what's been happening in the last 3 decades, and especially since 2006, when something called the Pension Protection Act was passed, that simultaneously caused many the defined benefit plans that had not yet already decided to close were very much incentivized to close after some legislation passed in 2001 and 2006 that changed the way you could do pension accruals and pension accounting for a traditional DB scheme, and simultaneously made it much easier for employers to automatically enroll and automatically invest employees. So there was this whole notion of we used to talk about the debification, right? Turning a 401k plan into a defined benefit scheme. Like, how do we make that happen? So for people in the United States who are lucky enough to work for an employer with consistent employment, who don't keep changing jobs, who have been contributing sort of 7, 8, 9, 10, 12% to their 401ks, there is no gap. But only half of all American employers offer a workplace savings program, and something like 1/4 to 1/3 of Americans don't work for an employer who offers a plan. So there is very much in America a sort of have and have not system. But there's been a number of people, sort of institutions and consultants and think tanks that have been tracking this quite closely. And the data would show that if you have been contributing steadily, you're fine. And if you change employers, right now, employers are typically auto-enrolling and auto-escalating, right? Increasing your savings rate. But because most Americans change jobs every 3 or 4 years, they're getting re-enrolled at that low rate again, and then missing, 3 or 4 or 5 years of escalation while the salaries increase, right? So there's a lot more work that I think we need to do if we want to have a sort of robust, more universal experience in America. That said, for people who have access to pension to 401k plans, I think the system works very well. So again, it's really a matter of luck, or if when you're looking for a job, if you understand enough to know that that's an important benefit that you should be looking for.
Yeah, that's interesting. I would say, even fascinating, because in Europe, I think many people think that the United States is one country, right? I mean, and one language and one currency and one pension system, and actually. if I understand well what you just said, I mean, the pension system is more a tax system, first of all, which confirmed the importance of taxation, you know, as a key tool, actually, to you know, to encourage people just to save. But at the same time, I get the feeling that it's rather fragmented, and maybe the portability, you know, between jobs of your savings is limited, and this is the case.
It's interesting. You know, it's not a system, right? It was designed to facilitate tax incentivized savings. And I still remember when I was a portfolio manager, I took over some accounts in the 90s, and the title on the account was still the Supplemental Savings Program, because that's what it was designed to be. It wasn't designed to be a pension. You know, the US doesn't, most people who have stopped working don't think of themselves as pensioners. They think of themselves as retirees, right? They think of themselves as people who've stopped working, not people who receive an income, right? Most people in America do get Social Security, and Social Security for sort of people with median and below median wages is actually rather progressive. So it does actually, you know, do a reasonably good job of wage replacement, especially if you're in the bottom quartile of earners. So the real burden for saving falls on wealthier people who have to save a significant amount of their income if they want to get to wage replacement. But there's no system. It is fairly portable in that most people know that they can or could, if they change jobs, either leave their 401k plan where it was, which is where a system like you have, Steven, would be great if you could see everything in one place, because people do lose track of their money. And in fact, there is a website, you know, Find My Lost Pension, because people just forget about them. And employers lose track of people as they move around. Maybe now with email, it's going to happen less. Secondly, you can roll it over into an individual retirement account or IRA. And the last thing that sadly many people do in the US is it's very easy to take your money out of the system. You can just take it with you. You pay a 10% penalty for income tax, and then you owe income taxes on the entire amount. So if your tax bracket was 30%, say, you'd end up paying 40% tax on the amount you withdrew. So if you had a $100,000 401k plan and you withdrew it, you'd have $60,000. So there is a lot of what we refer to as leakage in the American system, because people who change jobs every 2-3 years have these very small balances and don't understand what the consequences of rolling it out in their 20. I did that when I was 23 or 24 years old. I had, I don't know, it was $1,000, $2,000. If I had left that money alone, it would be, you know, I did the math once. It was really depressing. It would be $34,000 or something like that today from $800, right? I mean, really, really painful lesson to learn. But it is, and then you can also, if your employer chooses, some employers let you roll your old balance into your new plan. And that's the best thing to do. But of course, it's not really advertised, and it's not, you know, there's nobody helping you do these things, right? Unless you have a financial advisor. So that's actually one of the reasons I wrote my book, just because there's so many not very difficult things to do that are not very well explained in the system. It's up to the individual to inform themselves and to do these things. And that's, you know, I think a real weakness of the system.
Maybe also just to clarify or to contribute to the current debate, you know, in Europe, and debate about, you know, what should be done at the European level, member state level to promote pension. You know, we have the PEP, Pan-European Personal Pensions Product, but it is a product. And actually, when you are talking about, you know, 401k and the plan, you talk about plans, and I think it's just much more an account where you put just a number of, you know, and correct me if I'm wrong, but just rather than saving in a product like in a mutual fund in the US. So to what extent, you know, you have views on whether it's better just to offer an employee a product, a pensions product, than an account into which he can save and build a pension pot.
So in the US, you can invest your money with a financial services firm, right, with a broker or a bank. And you can do that with a taxable investment account or a tax exempt account, and that would be the individual retirement account. So that is just an account. An individual retirement account is nothing more than a savings and investment account that is exempt from taxes. And the old-fashioned IRA was exempt from taxes when you put the money in. It's exempt as it grows, and it taxes on the way out. Now we have something called the Roth for IRA, which is tax exempt on the way. You pay taxes, so it's taxable on the way in, and then it grows and is exempt on the way out. So there's two kinds of IRAs. It's a very confusing system. A 401k plan can only be offered by an employer. So it has to come through your employer. The employer is the fiduciary for the plan, which I think is another real weakness of the American system, because it requires the employer as fiduciary to make all of the decisions about the investments, the accounting, the platform provisions, all these very technical things. And the US is a country that seems to like to regulate through litigation. So, there have been an enormous number of lawsuits against employers for decisions that they've made for the 401k plan. And, this is a voluntary system. So plan sponsors, especially small employers, don't offer plans because it's expensive, it's confusing, and they might get sued. So it's a very high burden on the employer, and it requires the employer to develop a very sophisticated understanding of how all this works. So if you're, a very large employer with, like my former employer, JP Morgan, with 200,000 employees and a full-time pension staff of 10 or 15 people, it's fine. If you have a company with 50 or 100 employees, and you have the CEO, treasurer, the pension sponsor, and the janitor who are all the same person, it's very, very difficult to offer a plan. So I have hopes that the US system eventually will evolve to look more like the Australian or the UK system, or another system that has these sort of master trusts and master pools, because I think they're more cost efficient. And in fact, the US has just introduced the concept of a pooled employer plan. We call them PEPs as well, but it's from the employer, so that a single employer could join one of these things and not have to bear all the cost and decision-making burden of making all these decisions.
It's interesting because you mentioned Australia, I think maybe twice already today, the UK. As I said, I mean, in Europe, we mainly believe that it would be great if there was a 401k, because we know that's kind of, we feel, no, we consider, but from what you said, it is not the solution for everyone. So I think that we are talking a lot of best practices now, and to learn from best practices. And listening to you, they are probably good best practices, to learn from in the United States. But it would be great just to, just to see which one in another conversation, and not just focus our attention in Europe to European countries. I mean, just to extend to the US and Australia, and also to learn from best practices in countries like Sweden, and so we just have a lot to learn from each other, because it seems that there is no perfect system. Maybe there is no US system of pension, as you said, and it certainly appears that it's not so straightforward for American and young American just to start saving for retirement. So I believe this is one of the reasons why you decided to write your book. Is this the main reason that motivates you to write your book?
It is. I think Americans are notoriously poor savers, right? We have one of the lowest global savings rates in the world. And I think it's been this way for a long time. I don't know what it is about us, but we seem to have poor impulse control. So I really struggled to save when I was young, actually. And I talk about that a lot in the book. But because our system is voluntary, and because more Americans would rather talk about sex with their children than money, right? I think most Americans, get their first job and don't understand much about, how interest rates work if they get a credit card, right? How compound returns work if they invest their money. And one of the things I did a lot of research on and really started understanding more about in my former job, which was really to design and manage target date funds, which were to our default investment products in the US, is that many people feel a lot of shame and fear and guilt when they think about their own relationship with money. And it's a very bad sort of place from which to make rational long-term financial decisions. And so a lot of the reason I wrote the book was just to say, hey, look, a lot of people make mistakes. I made mistakes. Here's some simple things that you can do to put yourself in a better position, and you can start doing them right now. And here's how you can make things better from where you are right now. But without some of the, there's a lot of shaming that goes on, I think, in a lot of financial services literature. And one of the things I learned, I did a lot of focus groups and interviews, and at least in America, a lot of sort of regular consumers feel very disrespected and disengaged when they listen to the way financial services professionals speak. And I think some of that is because we are so heavily regulated, we have to be very careful with the way we say things. I think some of the challenge comes from the fact that in America, there is no system and there is no outcome that we're trying to deliver. But I think the other trick for defined contribution schemes around the world, if they're truly a defined contribution scheme with no sort of guarantee attached to it, is that there's no right answer, right? You don't know how long you're going to live. You don't know how long you're going to work. You don't know what market returns you'll have. So you really don't know with any certainty that it's going to be okay. So, and then again, because we're so highly regulated, we can't just say, yes, you'll be fine. I promise it'll be okay, because we can't say that, right? So I think all these things build a lot of uncertainty and distrust into the system. And so I really wanted to try to demystify some of that when I wrote the book.
Yeah, you mentioned uncertainty, and you said when just commenting on DC scheme, I mean, those DC schemes that have no guarantee. I was yesterday discussing with a group of young people from the European Youth Parliament, and bright people, because they are some in high school and some already at the university, but they are also engaged in this youth European Parliament. And I could sense from the comments of some of them also questions about the risk that you take by investing in the market rather than leaving your money in the bank. And someone mentioned, especially in the context that banks are offering some kind of guarantee, right? I mean, I would say the states, there is an organization around the banking system that guarantee to be reimbursed for a certain minimum. And I think in Europe, it could be maybe 100,000 euro. So those young people from 20, right? I mean, they just consider that this may be a reason why just to keep money in the banks. In the United States, again, the view I have is that there's a culture of investing, maybe of taking risk. But from the comments you just made, it looks also that convincing people, young people, to invest is not that easy. So, is the risk that, you have by investing in the market a reason for young American not to save enough for retirement?
I think in the US, speaking generically, there's a much higher comfort level with taking investment risk than I think. I've lived in Japan and Italy, and certainly in those countries when I was living there in the 80s and 90s and early 2000s, there was much less comfort with taking sort of equity risk, right? And I think, relatively speaking, the US stock market has always produced really very good returns over sort of any long 10-year rolling time horizon. I think the US has often been one of the best returning stock markets. So taking risk has generally been rewarded in the US, and I'm not sure you can say that in many other markets, right? So I think the US is, broadly speaking, comfortable. Young Americans, Gen Zers, having been very recently through two huge sort of 2008 financial crisis, or seeing their parents deal with it, and then the pandemic and the very, very short crash that happened then, are much more risk averse than their parents are. So we're seeing 20-year-olds, 20-somethings, people under 30, let's say in the US, investing much less aggressively, having much more of their money in cash. and being much more fearful of taking that investment risk. And I think that's a real shame, because it's the returns you make in your 20s and 30s that will make your retirement, assuming you save, right? That's really what's going to make that compounding really work for you. And if you miss just that one decade, you have to save twice as much money to make up for it. And so that's, again, one of the things I'm trying to help people understand, that, the market doesn't go up all the time, but it does go up over time. And people get scared.
Yeah. So in the US too, but probably, as you say, there's a bit reassuring that it's just kind of less than in Europe. So this is why, including at EFAMA, we try to, write brochure and engage with citizens and young individuals, just to explain in particular the merits of and the power of compound interest rates. Yeah, I'm looking at my watch. Unfortunately, we almost reached the end, and there were still so many questions we could discuss together. But maybe giving you the floor for 1 minute each. If the European Commission, is looking for the magic solution that could still solve or contribute to solve this pensions gap, and actually provide more financing through pension savings to cover the investment needs that Draghi has identified in his report. So would you have a wish of a measure? Which measure would you wish that the European Commission would consider to work on during the next political legislative cycle? Maybe starting with you, Steven.
I was afraid you were going to say that. And actually, I don't know one specific, that would be the thing, of course, that there would be one specific measure that would solve the majority of the problems. Well, I've been listening carefully about the whole 401k debate, and also the idea of ownership over your money. But I think, and that's linked to me to actually talking about pensions in terms of products and assets, it gets de-linked from the goal you actually want to achieve. And then people start using it for other means. And then you have a lot of investment as a society in tax deductibility and setting up frameworks. And then in the end, the money ends up being used for something completely different. So is that something for the European Commission to solve? Well, at least if their focus would be less on regulating the product and more on advancing the goal, that could be a thing. But don't ask me what specific measure would enter in that framework.
Thank you, Steven. Jerry?
Yeah, I think obviously there's a limit to how much the Commission can do in terms of, design of pension systems, because that's up to individual countries. I do think systems that take decisions away from people, and, you've got a framework that allows for good decisions to be made on behalf of people, and I think auto-enrolment is clearly one of those. I do think, though, on the investment side, and obviously the European Commission is looking for a lot of investment to improve the European economy, and it's clearly looking as pension funds, have a lot of money to invest. Those two things don't always match, because pension funds have fiduciary responsibilities. But I do think there is probably an opportunity for investments to be made available to pension funds that pension funds want to invest in. That can work both ways. And I do think working together to achieve that could be a good thing to focus on.
Thank you, Jerry. And based on your experience in the US and in the world, you're in Rome today, or in Italy, what's your recommendations?
I think a couple of observations. Large markets drive price efficiency, period, right? So the larger you can make the market that you're operating in, the more price competition you're going to see. And I would just put that out there. I guess the second thing I would say is, the importance of a professional fiduciary, I think, is a very important one. And in Australia, that they're commercial, right? They're vertically aligned, and I think they're fiercely competitive on price and return. I think in the UK, you've got sort of professional trustees. I think personally that the UK price cap that they put on default schemes was really unconstructive, because for a number of years people were managing to the cap, and now I think you're seeing a lot of competition come in and actually competing on price. But I don't think that was probably necessary because the market very quickly will take care of pricing inefficiencies. At least that's the experience I've seen, if the market is big enough and if the fees are transparent enough. So from a regulatory perspective, I think the more transparency you can drive in the way various costs are disclosed to, trustees, to fiduciaries, and to members, right, individual participants or employees, and the bigger the market you can make, the more likely you are to see really robust investment solutions emerge.
Thank you, Anne. So I'm afraid it's time to conclude. So a special thanks to you, Jerry, Steven, Anne, for your valuable insight and your time, and for sharing your expertise. Thank you also to all the online participants for your interest in the topics. I can only encourage all of us, to take today's ideas that were kind of discussed as a call to action to look towards building a more effective, inclusive, and resilient pension system. I wish you a wonderful evening and happy Thanksgiving in advance to all American friends, including Anne. Take care.